Good evening, all of you. Yesterday, I told some points regarding this income tax, regarding the objectives and the different articles. For example, 246.2, 246.3, 246.4, 246.5, 246.6. Like that, I had given you. And this class, it is nothing but the continuation for that. Because when we go for income tax, first of all, we have to first of all we have to understand clearly about this income tax, the rules and the history of income tax, and what are the slab rates and what are the flat rates. Yesterday itself, I told you about this flat rates. When you come across long-term capital gain, 20% is a flat rate. When you go for a lottery, winning a lottery, okay, you have to pay 30% tax. Like that, yesterday I told you some points regarding this income tax. Today I am going to take the slab rates, that is basing upon the income of the people. Okay, we are going for the slab rates. Okay, so that thing you must be very cautious and you must be very important, because when you go for this income tax, as I told you already, that okay, taking into account every year's financial budget, the slab rates of income tax, it will change, okay, every year. And some of the rules, even though they are constant, and some of the rules, they will change according to the financial budget of every year. So don't be of that opinion that income tax will be the standard one and it is the meaning the unchanged thing. Okay, it is okay, depending upon the financial budget, will come across changes in income tax. Certificates, circulars and clarification issued by CBDT, Central Board of Direct Taxes. They will give some clarifications as well as circulars basing upon the payment of income tax by the people, by the individuals. And these circulars and clarifications you'll come across every year. Okay, every year the CBDT people, they will give the circulars as well as the clarifications. The Indian Central Board of Direct Taxes, CBDT, is the apex institution that regulates the overall administration of the direct taxes, that is income tax and wealth tax. Section 119 of the Income Tax Act of 1961 empowers CBDT to issue certain orders, instructions, and directions to the Revenue Department to assist in the interpretation of the law. So, taking into account 119, section 119 of the Income Tax Act of 1961, it has given powers to the CBDT people to send or to change the circulars, clarifications, instructions, orders, everything, okay, to the Revenue Department. Okay, CBDT circulars are binding on income tax department officials. That is, they have to follow that. Circulars are not binding on SSE. They will have binding on the income tax officials, but there won't be any binding on the SSEs. Circulars are not binding on CIT appeals and other affiliate authorities. So whatever it may be, the circulars given by the CBDT, okay, they are not binding on CIT, Central Income Tax, and other affiliate authorities. Next, the decisions must be taken by High Court, and whatever it may be, the decision given by High Court in any case, okay, that is the final And if not possible, they have to go to Supreme Court, and whatever it may be, the Supreme Court tells it must be taken as granted. And even then, when the people, when they are not satisfied, they can refer that to the Parliament. Next, tax rates. What are the tax rates that we come across? Okay, when you go for slab rates, the slab rates, they will differ. I told you already that you'll come across, okay, flat rates and slab rates. Flat rates are fixed in nature, they won't change, but slab rates, they will change. Okay, when you take into account the senior most citizen, that is above 80 years of age, up to 5 lakhs nil, 5 lakhs 1 rupee to 10 lakhs 20%, above 10 lakhs 30%. This is for super senior citizen. Super senior citizen, that is a person who attains, who is having more than 80 years, that person slab rate is like this. Next, okay, senior citizen, that is who is above 60 years of age and below 80 years of age. For that person, the slab rate is up to 3 lakhs nil, 3 lakhs 1 rupee to 5 lakhs 5%, 5 lakhs 1 rupee to 10 lakhs 20%, above 10 lakhs 30%. And surcharge also it will be there. It is 10% of income tax on of taxable income exceeding 50 lakhs but does not exceed 1 crore, and 15% of income tax of taxable income exceeding 1 crore subject to marginal relief. You'll come across marginal relief in this. Next, after that, you have to pay some extra money. Okay, without taking into account the surcharge, you have to pay some additional amount. That is, educational cess 2%, secondary and higher educational cess 1%, and 1% health cess. Okay, they must be paid with the tax amount. Resident individuals having taxable income does not exceed 5 lakhs shall be entitled to for a tax rebate equal to the amount of income tax or 12,500 rupees, whichever is less under section 87A. We'll call this thing as tax rebate. Okay. Now, when you go for companies, 40% of the income, whatever they get, they have to pay. And when you come to a partnership company, 30%. Educational cess 2% plus 1% health cess, 1% for secondary and higher education cess also to be taken into account. A domestic company, when you take into account, okay, it is liable to pay a tax of 30% plus surcharge at 7% on tax payable, where total income of the company exceeds 1 crore, but not less than 10 crores. Okay, the surcharge, if it exceeds 10 crores rupees, the surcharge percentage is 15% plus education cess 2%, okay, plus 1% secondary and higher education cess plus 1% health cess. For foreign company, it is 40%, 40% plus surcharge of 2% of income tax if it exceeds 1 crore but does not exceed 10 crores. The surcharge rate is 5% when it exceeds 10 crores plus all these things. That is educational cess 2% plus 1% secondary and higher education cess and 1% health cess. Okay, these are the things that we will come across regarding the slab rates that when we go for income tax. Okay, now when you take into account the direct taxes, what are direct taxes? The direct taxes are income tax, it occupies a major role, then wealth tax, then corporate dividend tax, CDT, we'll call that thing as CDT or DDT, dividend declared tax. Next, excise duty, then gift tax. In this gift tax, previously, okay, the donor has to pay the tax amount. There is a limit, slab limit. Okay, if it exceeds 10,000 rupees, if the gift value, if it exceeds 10,000 rupees, the donor has to pay. Okay, the donor has to pay 30% of tax. 30% of tax he has to pay whenever the gift value, when it exceeds 10,000 rupees. But at present, the donee has to pay, that is the person who is receiving the gift, okay, in the form of cash, the donee has to pay the tax amount if it crosses 10,000 rupees. Okay, previously, okay, when you go back for previous years, if it crosses 7,000 rupees, the donor has to pay. Now that amount, it was increased to 10,000 rupees, and the donee, the person who is receiving the gift, he has to pay the tax, that is 30%. Plus educational cess, everything is common. Next, what are the things that we will come across in income tax? Basis of charging income tax, incomes exempt from income tax, computation of income under various heads, clubbing of income, set off and carry forward of losses, permissible deductions. Okay, deductions you will come across 80cc, 80u, rebate and reliefs, double taxation relief, determination of tax in certain cases, non-residents, tax on dividends distributed by domestic companies, income tax authorities and their powers, surveys, search and seizure, assessment procedure, assessment of firms, collection and recovery of tax TDS, tax deducted at source, advance tax, refund, advance rulings, appeal and reversion, acquisition of immovable property, penalty and prosecution. These are the various things that we'll come across when we go for income tax. Okay. Now, after that, what is this corporate dividend tax, CDT? Or we can also call, I told you that we can also call that thing as DDT, dividend declared tax. Okay, what is this CDT? Whatever it may be, the dividend declared to equity shareholders. On that, this CDT will be charged. That is, the CDT will come into existence. Joint stock companies are required to pay tax at 15%. Okay, 15% plus surcharge 12%. Okay, and HEC 4% on dividends to the shareholders. One thing you have to keep in mind is, okay, whatever it may be, the equity shareholders, whomever it may be, the equity shareholders, and whatever it may be, the dividend declared to them, on that only we have to charge the CDT, that is corporate dividend tax. Okay, the effective rate shall be 20.358%. Okay, previously it is 17.304%, but at present it is 20.358%. And when you take into account, there is also an inclusion. Okay, companies in addition to dividend tax pay corporate income tax on the income of the company at a flat rate of 30%, and surcharge at 7% on the income tax if the income exceeds 1 crore but does not exceed 10 crores. If it exceeds 10 crores, then the rate of surcharge will change from 7% to 12%, and remaining things, whatever it may be, that is 2% educational cess, 1% okay, health cess, and 1% secondary and higher education cess. These are compulsory. So when you take into account at present, the percentage is 20.358%, and previously it is 17.304%. Okay. Now, state level direct taxes. What are state level direct taxes? Agricultural income tax, okay, land revenue, and provisional tax. These are the state level taxes that we come across, state level direct taxes. What is this agricultural income tax? Okay, Article 270 of the Constitution of India gives exclusive powers to the state legislature to make laws with respect to the taxes on agricultural income. The agricultural income is a state subject and is exempt from tax. One thing you have to keep in mind is, whatever it may be, the agricultural income that we come across, it is exempted from tax. And sir, when you are telling that this agricultural income is exempted, again, why you are telling this? You see, up to certain extent, it is agricultural income, and after that, it is nothing but non-agricultural income. So, in order to get the tax on non-agricultural income, what we have to take into account is we have to club the agricultural income and non-agricultural income. If the agricultural income is 5,000 rupees, there is no necessity for you to take into account the tax amount. If it is more than 5,000 rupees, then only you are supposed to take or charge the tax. So when you want to derive this, tax on non-agricultural income, first what you have to do is we have to take into account the summation of agricultural income as well as non-agricultural income, and we have to take into account the tax. After that, we have to take into account the exempted limit, that is, we have to deduct that. Okay, and we have to find out the tax. Then from the top one, if you deduct this, automatically you are going to get the tax on non-agricultural income. Land revenue is collected by the state governments from the agricultural land. It is one of the oldest taxes levied by the government, land revenue. What is the revenue that we are getting from the land? Okay, when you are getting revenue from the land, you are supposed to pay the tax. And provisional tax. This is compulsory for all the people, provisionals. Those people who are in provisional category, those people, they are supposed to pay the tax. And it differs according to the state government. Sometimes previously people, they used to collect 50 rupees, 80 rupees, like that they used to collect. Now the amounts, they were changed by the state government, and people, they are collecting 150 rupees. At present, the provisional tax, okay, is 150 rupees. And this provisional tax, it differs from one provision to another person. For example, for lecturers, it is some percent. For doctors, it is some percent. For lawyers, it is some percent, some amount. And for engineers, it is some amount. Like that, the provisional tax differs from provision to provision. Okay, salaried, state government fixes a tax on each type of occupation known as provisional tax. Okay, salaried employees, they will have, business they will have, and professionals like advocates, chartered accountants, doctors, lawyers, all these things. Okay, all these people, they will come under this provisional, and they have to pay this provisional tax compulsory. And after this, we are going for the basic concepts that we come across. When we go for basic concepts, first of all, we have to take into account the scope of income. That is, what is the income scope? The income tax under section 2, subsection 24 specifically includes 21 types of receipts or benefits to be considered as income. The Act also specifies various other notional items which are known as deemed incomes. Notional items, just for namesake only, they'll come, and we will call them as deemed incomes. Is going to be the income. Deemed income means is going to be the income. Okay. The definition of income under this act is an inclusive definition and includes some other receipts also, which are ordinarily treated as income. Generally, income means some periodical receipt in cash or kind coming from a certain source with some regularity. This is the main definition of income. This is the main definition. Whatever it may be, the amount that you are receiving, either in the form of cash or in kind, from a particular person or from a particular organization or from a particular business, whatever it may be, it must be treated as income. When you go for this thing, profits and gains, dividends, voluntary contributions, value of any perquisite in profit, okay, or profit in lieu of salaries, any special allowances, any allowances grant to SSC, perquisites or benefits received by a director, discharged by a company of an obligation of a director, benefit or perquisite obtained by representative assessees, any sum chargeable to income tax under sections 28, 41, and 59. Okay, these are all the incomes that we come across. And I'm going to tell you the other things regarding this deemed income and various items, various receipts that we come across. Okay, tomorrow in the same video class at the same time. Thank you. Until then, have a nice day.